So if you've been watching the news, there's some scary headlines out there about the stock market potentially crashing. Bond yields are increasing, tech stocks are being sold off, and inflation is expected to come. Hey friends, welcome back to the Chris Chaz Show, and in this video I'm going to be going over the 7 steps you can take before the next market crash. But before we jump into it, make sure you smash the like button and subscribe if you haven't already. The number one thing you should do before the next stock market crash is to have an emergency fund. This is one of the easiest things to do to make sure you last through the next stock market crash, and hopefully you won't end up in debt. If you haven't already done so, make sure you have 3 to 6 months worth of your expenses saved up in cash. Side note, if you don't know what your monthly expenses are, start tracking your expenses ASAP, and also start a budget and stick to it. Having an emergency fund acts as a financial safety net for you. This means you won't have to sell off your stocks in order to pay for your expenses if, in the worst case scenario, you lose your job, or your salary gets cut, or an unexpected financial cost comes up. And the second step you should take is to diversify. If you've decided to YOLO your money into a meme stock, there's a high chance that you will lose all of your money in the next stock market crash. Ideally, your investment portfolio should be diversified across asset classes, sectors, and countries. The more you spread your money, the more you reduce your risk and volatility. For example, if you have a well-diversified portfolio of, say, bonds, stocks, cash, property, and even some Bitcoin, if one of these markets does fall, the others should make up for that loss. You can even diversify further by investing in markets outside of Australia, such as the US or China. And finally, you can diversify across different sectors. This is important because in the past we've seen certain sectors completely crash. For example, if you had been an investor in only tech stocks back in the 1990s, you would have probably lost all of your investments thanks to the dot-com bubble. My third tip is to stop checking your portfolio every day. As the doom and gloom headlines start rolling in during a stock market crash, it can be very tempting to wake up every morning, log into your brokerage account and check your portfolio. Don't do that, because you're only going to stress out when you see that all of your investments are down and the entire screen is just filled with red. Staring at your phone or laptop every day isn't going to magically will the stock market to rally back up. It's only going to stress you out, it's going to make you panic, and maybe you'll even make some bad financial decisions. Speaking of bad financial decisions, don't panic sell. This is one of the worst things you can do in a stock market crash. Please don't make this mistake that I made and panic sell in a market crash. So back in March 2020, when the stock market was nosediving, I got scared and decided to sell 453 Afterpay shares at $16.42. This was right after the stock had recovered after plummeting all the way down to $9, driven by a massive sell-off that was sparked by the pandemic. And although I did end up with a small profit and not a loss, if I had held on to those shares, they would be worth a whopping $46,822.08 today. Talk about one expensive mistake. It's also good to remember that although you might temporarily lose, on average, 33.18% in a bear market, during a bull market, you'll see an average gain of 158.52%. Also, on average, a bull market lasts 4.7 times longer than a bear market. So keep calm and don't panic sell. Another thing you should do is you should keep investing. Study after study shows that the best thing you can do is to keep investing regularly and hold. In a stock market crash where everything is turning red, there's negative signs left and right, it can be really scary to continue investing. It can be even scarier when you've decided to stick to your plan and continue investing, and then every time you buy in, the stock market keeps getting lower and lower and lower. In situations like this, dollar cost averaging is your best friend, because long term it's one of the best ways to build wealth, but only if you stick to it. If you don't know what dollar cost averaging is, it's just regularly investing a certain amount into an investment. For example, let's say every month you put in $500 into a Vanguard ETF. That's dollar cost averaging. Dollar cost averaging can provide several benefits, especially during a stock market crash. Firstly, it reduces the chances of missing out on the best performing days in the stock market. And missing out could mean a significant reduction on your returns for your investment. In fact, if you miss out on the 10 best days on the Australian stock market over the last 14 years, your overall return would have been reduced by 37%. If we double those days to 20, then your return is reduced by 57%. And if we were to double that to 40 days, your return will be reduced by a whopping 76.8%. Which means if you had invested $10,000 in 2003 and you missed out on the 40 best performing days in the market, you would have ended up with a total of $7,935. The second benefit from dollar cost averaging is that it helps remove emotions from investing. During a market crash, it can be psychologically challenging to keep on investing when there's all this fear and uncertainty in the market. But if you stick to dollar cost averaging, you're not going to be fazed by the market going all the way down or going all the way up. And thirdly, dollar cost averaging prevents you from trying to time the market. You might be telling yourself, I'll invest at the very bottom of the market. I'll just wait. So you wait and wait and wait. And all of a sudden the stock market has shot back up. But you reassure yourself that there'll be another bottom. So you wait and wait and wait, and you never invest, subsequently missing out on the best performing days in the markets. Remember, as the saying goes, it's not about timing the market, it's about time in the market. Another thing you can do to prepare for the next stock market crash is to build multiple income streams. For most people, their main source of income is their salary, and it's often the only source of income. This means during a market downturn, if you lose your job, you're going to have no other income you can rely on. If you want to build wealth and become financially secure, it's important to build multiple streams of income. But don't just take my word for it. A US study showed that self-made millionaires have multiple income streams. In fact, 65% of self-made millionaires in the US had 3 streams of income. Some of the income types that these millionaires had include investment income, earned income, royalty income, rental income, capital gains, profits, and interest income. I know what you're thinking, this seems unrealistic. How can the average Australian build up multiple sources of income like a millionaire? Well, the answer to that is to start with just one additional income stream. And the easiest way to do so is to pick a high interest savings account and put your emergency fund in there. Check out my best savings account in Australia video, I'll leave a link in the description, where I go into detail what banks are offering the best high interest savings account. Another realistic income stream that you can build up is from stocks, specifically dividends that are paid out by listed companies. An easy, low-cost way to receive dividend income is to invest in index fund ETFs, such as Vanguard's Diversified High Growth Index ETF, ticker symbol VDHG. Index fund ETFs typically pay the dividend on a quarterly basis, and the amount of the dividend will vary depending on the underlying companies that the ETF consists of. The last thing you should do before the next market crash is to think long-term when it comes to investing in stocks and index funds. If you need this money that you're investing in, say, 3 to 5 years, then it's probably not a good idea to invest in stocks or index funds. Research has shown that if you hold stocks for a short time, your chances of losing money are much higher. Conversely, the longer you hold on to your investments, the better the chances you'll make money. A 2011 report by the ASX showed that if you had invested in Australian shares for 10 years to December 2010, you would have achieved a gross return of 8.4%. And if you had invested for 20 years, your return would be 11%. This is also true for international markets, such as the US. In fact, if we look at the US stock market return, on a rolling annual basis, the S&P 500 has dropped 16 times over a 1-year period since 1950, but it's dropped 0 times in any 20-year period. This is even factoring the worst market crashes in history. We're talking the Great Depression, Black Monday, the dot-com bubble, even the global financial crisis. Even with all these market crashes, an investor would have ended up with gains if they had made an investment in the S&P 500 and held it for 20 years uninterrupted. Now, it's important to remember that past performance is no guarantee of future results. However, it does suggest that long-term investing in stocks will generally yield a positive result, if given a lot of time. Thank you for watching. I hope you enjoyed this video and you've learned a few tips to prepare for the stock market crash. If you did, make sure to smash the like button and subscribe if you haven't already. As always, an important disclaimer, I am not a financial advisor, this is not financial advice. This video and my channel is for general information only. As with anything in life, you should do your own due diligence and seek independent advice.